I'm Brenda Kelly and I'm a technical analyst with IG. So the Euro-Swiss was a somewhat boring trade quite recently. We found in the same way as the Japanese yen was benefiting from safe haven flow versus the US dollar, the Swiss franc was also seeing the same amount of capital there. And again, that was hurting the export sector in Switzerland. So what we had was the Swiss National Bank, Mr. Jordan, coming out and saying he was putting a floor on the Euro-Swiss pair, which is around the 120 level. And for quite a period of time, the market barely fluctuated from that level because there was no real move for it to go, but it helped to get the Swiss economy back on an even foot. Obviously the Swiss franc is seen as a bit of a safe haven because of the, I suppose, politically stable and fiscally stable country that Switzerland actually is, whereas the euro was struggling from a lack of belief and a huge degree of uncertainty in regards to its existence or the longevity of that currency. So nowadays we have seen a stronger euro as the certainty has returned, or certainly increased confidence has returned, and the Swiss franc is no longer benefiting, if we will, from the capital flow. That being said, I would say that if we did see the Euro-Swiss head down towards that 120 level again, you would see some Swiss National Bank action, and I would be inclined to say that the floor still remains. Well, the fact is, from the very beginning with currency trading, if you're trading perhaps the sterling dollar, the cable as we call it, you've got at a £1 per point trade an exposure of over £15,000 at current trade levels, and that is quite a significant amount, particularly if you've never done this before. It wouldn't be for the rookie investor or trader, I wouldn't say. Certainly it can be volatile, certainly it can be profitable, but on the downside, because it's margin related and because of the volatility, if you're on the wrong side of the trade and if you're not keeping up to speed with your risk management that you need to, then you can ultimately suffer a great amount of losses. I would be inclined to say that you might kind of start off on maybe some individual shares, lower price shares, get a feel for how spread betting and see if these actually work, how margin trading actually works, and that way you can make smaller profits, smaller losses, and then once you've established yourself and you think you're able to deal and to be able to know the different foibles of the different central banks, which is very important at the moment, then you can make attempt on FX trading. But I would still keep those stakes quite small, no more than £1 a point to start. It is a very, very popular way of trading, and there are many people who trade for a living just trading FX on its own. That said, that we have a huge amount of clients who would trade 9-to-5 jobs, and they would do their FX trading probably on a longer term basis because they haven't got time to watch the markets every day, but they would still be looking to generate some income from FX trading later on in the evening, or just by using orders rather than market trades, where they can ascertain a level that they would like to get in at. And if the market goes to that particular level, their order will trigger and they will take on a position, be it long or short. And you can also attach stop losses and limit orders or take profit orders to these orders to get into the market. And they can be a very successful way of trading, sometimes better than sitting and watching a screen as the market fluctuates, because it stops you from being a little bit too trigger happy, and you're inclined to let your profits run and your stop losses actually trigger rather than moving them down when you really should just leave them alone.